Losing a parent is, of course, incredibly difficult. And on top of all the emotions, the financial tasks that follow can feel absolutely overwhelming. So this explainer is designed to give you a clear, step-by-step guide to navigating it all so you can move forward with a little more confidence. Let's just start by acknowledging the reality of the situation. It is completely, 100% normal to feel mentally foggy while you're grieving. So this guide is here to help you make sense of the financial side of things when everything else feels, well, just complicated. It can feel like you're staring at a mountain of paperwork. So, where do you even begin? We're going to break this down one step at a time. And we'll start with one of the most common and, frankly, often confusing inherited assets, an IRA. Right. So when you inherit an individual retirement account or an IRA, it doesn't just become yours like a normal bank account. Nope, it comes with its own specific set of rules, and understanding them is really the first step to making smart decisions. Okay, so this slide really highlights the two critical rules you need to burn into your memory. First, you've got a 10-year deadline to get all the money out. And second, every single dollar you take out is taxed as ordinary income. The key takeaway here is pretty simple. While you can't avoid the tax, you can absolutely manage it. Now, what's really interesting about this is how clearly it shows the power that you have. I mean, look at this. If you take all $85,000 at once, it just gets stacked on top of your other income and could easily create a huge tax bill. But spreading it out, well, that gives you a much smaller, way more manageable amount to deal with each year. You know, the most important thing to get is that this 10-year window gives you flexibility and control. Spreading out your IRA withdrawal isn't just a suggestion, it's the main tool you have to avoid a massive one-time tax hit. You can get strategic, maybe take more in a year your income is a bit lower, for example. The point is, you are in the driver's seat. All right, so now that we've covered the rules for IRAs, let's switch gears and turn to other common assets, like the family home or brokerage account. These have a very different and often much more favorable set of tax rules. A transfer on death, or TOD account, is really designed for simplicity. The assets transfer directly to you without having to go through a long court process. And notice that phrase at the end, step up in basis. That is a very important concept we're about to dive into. So this slide explains why that phrase is so important. Think of it like this. The cost basis is just the original value used to figure out the taxes on any profit when something's sold. With an inherited asset, the IRS essentially hits a reset button, updating that value to whatever the asset was worth on the date of death. And here's a really powerful example. Let's say the home was worth $300,000 when you inherited it, and you sell it for $302,000. You only owe capital gains tax, that's the tax on profit, on that tiny $2,000 difference. You're not taxed on all the decades of growth before you owned it. This rule can literally save you tens of thousands of dollars. It's huge. Of course, the decision of what to do with a family home is both financial and emotional, isn't it? Selling gives you quick access to the money and simplifies things, especially if you have siblings. But keeping it offers the chance for rental income or even a new place for you to live. There's just no single right answer, only what's right for you and your family. Now let's address a topic that causes a lot of stress and a lot of confusion: debt. Are you on the hook for your parents' credit card bills or medical expenses after they're gone? Okay, this is the single most important rule to remember. You are not personally responsible for your parents' debts. The estate, which is just the collection of all their assets, is responsible for paying them. The only time this isn't true is if you co-signed on a loan. Otherwise, the debt is not your problem. So before any money or property gets distributed to the heirs, the person in charge of the estate has to use the estate's funds to pay off these types of bills. Whatever is left over after all the debts are settled is what makes up the actual inheritance. So, knowing the rules is one thing, but avoiding common pitfalls is another. Let's reframe these potential mistakes into a positive, proactive checklist that'll keep you on the right track. Thinking of this as a proactive checklist just helps you stay in control. These are concrete actions you can take to protect the value of the estate. For instance, freezing your parents' credit is a simple step that prevents identity theft, while double-checking that step up in basis before you sell anything ensures you don't overpay Uncle Sam. We've covered a lot of ground here, from IRAs to real estate to deaths. Now, let's pull all of that information together into a simple, manageable action plan that you can start on today.
Seriously, don't try to do everything at once. Just focus on these 3 concrete tasks. Getting plenty of copies of the death certificate is absolutely essential. Gathering all the financial documents gives you a clear picture of what you're working with. And a separate estate account keeps all the finances clean and organized right from day one.
Now, while this guide gives you a really strong foundation to build on, every family situation is unique. And sometimes getting some personalized guidance from a professional can make all the difference and give you real peace of mind. If you have questions about your specific inherited accounts, or you want help creating a tax-efficient withdrawal strategy, or maybe you just need an expert to talk through your options with, please reach out. At the Annuity Expert, we specialize in beneficiary assistance, and our services are always free of charge. We're here to help you make the smartest choices during this difficult time.